Hi, myself Mahesh Machi. My roll number is MB2205. Subject of presentation is financial regulation and topic is credit rating, concept, types and functions. Let's see the definition of credit rating. Credit rating is an analysis of the credit risk associated with financial instrument or a financial entity. It is a rating given to a particular entity based on the credentials and the external to which the financial statements of the entity are sound in terms of borrowing and lending that has been done in the past. Usually is in the form of detailed report based on the financial history of borrowing or lending and creditworthiness of the entity or the person obtained from the statements of its assets and liabilities with an aim to determine their ability to meet the debt obligations. It helps in assessment of the solvency of the particular entity. These ratings based on detailed analysis are published by various credit rating agencies like Standard and Poor's, Moody's Investors Service, and ICRA, to name a few. Creditworthiness default financial instrument debt credit agencies. Let's see the concept of the credit rating. Credit rating is an assessment of the creditworthiness of an individual, company, or government entity. It is a numerical representation of the credit risk, indicating the likelihood that the borrower will default on their financial obligations. Credit ratings are typically assigned by credit rating agencies, which analyze the financial health, payment history, and other relevant factors of the entity being rated. The primary purpose of the credit rating is to provide investors, creditors, and the general public with the standardized measures of credit risk, aiding them in making informed decisions. Concept of the credit rating. The concept of credit rating involves evaluating the creditworthiness of a borrower based on various financial and non-financial factors. Credit rating agencies assess the ability and willingness of the borrower to meet its financial obligations, such as interest payments and the repayment of principal. The process involves thorough analysis of financial statements, business operations, industry conditions, and other relevant factors. There are few types of credit ratings, like issuer credit rating. Definition. This type of rating assesses the overall creditworthiness of a specific entity such as corporation, government, or municipality. For example, an ICR for a company might be AAA, AA, single A, triple B, etc., with each letter grade representing a different level of creditworthiness. Issue specific rating. Definition. These ratings are assigned to a particular financial instrument such as bonds, preferred share, stock, or other debt securities rather than the issuer as a whole. Example, a bond issued by a corporation might have a specific credit rating different from the overall credit rating of the issuing company. Credit default swap rating. CDS ratings are associated with credit default swaps, which are financial derivatives used to hedge against the risk of the default. For example, CDS rating might indicate the credit risk associated with a specific financial contract designed to protect against the default of a particular issuer. Structured finance rating. This type of rating is applied to complex financial products and instruments, such as mortgage-backed securities or collateralized debt obligations. For example, a structured finance rating might be assigned to a tranche of mortgage-backed security, reflecting the risk associated with the specific portion of the security. Country rating. Country credit rating. Definition. Country credit ratings assess the credit worthiness of sovereign nation and its ability to meet its financial obligation. For example, countries may be rated on a scale of such as AAA, AA, etc., which with each grade reflecting the perceived risk associated with lending money to that country. Municipal credit rating. Municipal definition. Municipalities, including cities and local governments, can also be assigned credit ratings based on their ability to meet financial obligations. A city may receive a credit rating that influences the interest rates it pays when issuing municipal bonds. Bank credit rating. Banks are also subject to credit ratings that assess their financial health and ability to meet obligations. Bank may receive a credit rating based on its capital adequacy, asset quality, management quality, and earnings and liquidity. Let's see the function of credit rating. Risk assessment function. Credit rating helps assess the credit risk associated with the particular borrower or financial instrument. They provide an indication of the likelihood of default or a failure to meet financial obligation. Investors and creditors use credit rating to gauge the risk of an investment or loan. Higher rated entities are perceived as less risky, while lower rated entities are considered riskier. Investment decision making. Investors use credit rating to make informed decisions about buying or selling financial instruments. Higher rated securities are often considered safer investing, while lower rated securities may offer higher returns but come with increased risk. Credit rating influence investment portfolios and asset allocation strategies, guiding investors towards instruments that align with their risk tolerance and investment objectives. Cost of borrowing. The credit rating of an entity can impact the interest rate it receives when borrowing money. Higher rated entities typically enjoy lower interest rates due to their perceived lower risk, while lower rated entities may face higher borrowing costs. Companies, governments, and individuals with higher credit ratings can assess credit rate more favorable terms, reducing the overall cost of borrowing, issue credibility, and reputation. Credit rating contributes to an issue credibility and reputation in the financial markets. Higher credit rating can enhance an issuer's ability to attract investors and access capital at competitive rates. Entities with strong credit ratings are often seen as more reliable and trustworthy, fostering a confidence among investors, creditors, and other broader market regulatory compliance. Certain regulations and investment guidelines may require institutional investors, such as pension funds and insurance companies, to adhere to specific credit rating criteria. Credit rating helps ensure compliance with these regulations. Entities seeking investment from institutional investors may need to maintain a certain credit rating to remain eligible for inclusion in investment portfolio. Let's see some advantages of credit rating. Risk assessment. Credit rating provides a systematic standardized way to assess the credit risk associated with particular entities or financial instruments. Investors and creditors can make more informed decisions about where to allocate their fund based on the perceived level of risk and confidence. Higher credit ratings instill confidence in investors as they signal a lower likelihood of default. This can attract a broader investors base and reduce the cost of capital for the rated entities with strong credit ratings may find it easier to raise capital in financial market liquidity. Credit ratings to enhance market liquidity and providing common benchmark for assessing credit risk. Standardized rating facilitate trading in the secondary market. Investors can buy and sell securities more easily, contributing to overall market efficiency. Cost borrowing. Entities with higher credit ratings generally enjoy lower interest rate when borrowing money. This can result in significant cost savings over the life of the debt. Lower borrowing costs can improve the financial health of borrowers and make capital more accessible. Let's see the disadvantage credit rating. Potential for error biases. Credit ratings are subject to error and biases, and they may not always accurately reflect the true creditworthiness of an entity. Inaccurate ratings can lead to misinformed investment decisions and contribute to market instability. Rating agency influence. Credit rating agencies hold significant influence, and their downgrades or upgrades can trigger market reactions. This influence may result in hiding behavior among investors. Over reliance on rating agencies can contribute to market or volatility and create a self-fulfilling prophecy where downgrades will lead to a sell-off in securities. Limited timeline. Credit ratings may not always reflect the most current information, as rating agencies typically update their assessments periodically. Market conditions can change rapidly, and delay updates may result in outdated credit assessment, leading to potential misjudgments. Homogeneity of rating. Ratings are often grouped into broad categories, leading to a lack of granularity. Different entities within the same rating categories may have varying risk profiles. Investors may overlook differences in risk within a given rating agencies. Rating category, potentially underestimating or overestimating the actual risk. Conflicts of interest. Credit rating agencies are paid by the entities they rate, creating a potential conflicts of interest. There may be a pressure to provide favorable ratings to maintain business relationship. Conflicts of interest can undermine the independence and objectivity of credit ratings agencies, leading to biased assessment. You can see the small chart of credit rating. Numbers are given. That 329 credit score will be the bad. 630 to 689 will be fair. 690 to 719 good, and 720 to 850 will be the excellent credit score for the borrower or any individuals. Okay, that's all for my presentation. Thank you. Thank you so much.